Hi everyone, it's Jack back with another video, and today I'm going to be talking about Nvidia, which released its earnings report a couple of hours ago. Fairly lukewarm reception from the markets, up around 1 or 2%, which can be seen as a positive. It hit its revenue expectations just about what missed on the bottom line, which is pretty much what most companies are doing right now. It's $159, let's call it $160 tomorrow. That's decently off its 52-week low, up 60% from $108, but still way off its 52-week high. It's down around 47% year to date. Clearly having a rough year for chip and semiconductor stocks in general. Its fabulous nature has protected it a little bit, but its gross margin is declining and its PE ratio is climbing, and its market cap is now just $400 billion from around $700 billion earlier on this year. I want to establish, looking at this report and some valuation metrics, where this is a buy, sell or hold right now in my opinion. If you like enjoying the videos, like and subscribe. Let's get into it. So first of all, here's financial summary. We're of course most interested in the GAAP metrics. Revenue wise, down 17% year over year, 12% quarter over quarter to $5.9 billion. Now while this looks bad on the surface, and don't get me wrong, it is bad, this is broadly in line with analyst expectations. The wide semiconductor industry is suffering a little bit, and Nvidia is no exception to that. Its gross margin has took a big hit year over year, but it's actually up significantly quarter over quarter, up 10 percentage points quarter over quarter to 53.6%, but that's still way down from the 65% it was getting this time last year. Operating expenses, $2.5 billion. That's kind of up 7% quarter over quarter. That's kind of a normal increase, but up 31% year over year, which is a staggering increase. Operating income of $601 million. That's up significantly quarter over quarter, but down 77% year over year, an absolutely frightening decline. Net income, $680 million. That's up quarter over quarter again, but a frightening decline from the year prior, down 72%, meaning the earnings per share of this company is down significantly. This business reports itself as two reportable segments: computer networking, which is up 27% year over year, and graphics, which was down 48% year over year in terms of revenue. But this doesn't give so much insight. It's better to look at the market platform, where we can see individually where that revenue is coming from. And the data center segment was by far the biggest winner here, up 31%, has been carrying the company, and it's been carrying the company for a while. Gaming has came down significantly since last year, and it continues to go down 51% to now $1.5 billion year over year, and a further decline of 23% quarter over quarter. Professional visualization is dwindling to basically nothing, down 65% year over year. Automotive is up 86%, which is really impressive growth from a fairly low base. OEM has also decreased massively, again down 69%. Gaming 51%. Professional visualization 65% and OEM 69%. While these are dwarfed by the gains of the data center business, these are definitely concerning losses. Data center business is clearly carrying the company, and we're hoping that continues going forward. But again, this is subject to orders from larger companies, which you would imagine is going to be scaled back if we go into recession. So I could see more pain in Nvidia's future for sure. Management provided a little explanation to some of these revenue problems. One is the new restrictions on exports of the A100 and H100 based products to China, destined for certain systems or entities in China. These restrictions impacted third quarter revenue and are likely going to impact future quarters. They also mentioned the recent transition in verifying Ethereum cryptocurrency from proof of work to proof of stake. It's reduced the utility of GPUs for cryptocurrency mining, and they're going to see more aftermarket sales because many GPUs where they were previously being sold for $2,000 or whatever, like double markup, they now come back down to earth, and they're being sold on the aftermarket at relatively cheap prices. So Nvidia aren't selling new GPUs at the minute. Also, weak desktop and laptop sales demand. Sequential demand was primarily driven by lower GPU sales for laptops. OEM and other revenue was down 69% and 48% sequentially. This was driven by lower Jetson and notebook OEM sales. Automotive revenue was up, primarily driven by revenue from self-driving solutions, and I believe this is going to continue. It's a nice trend going forward and a potential big market for Nvidia. Another concerning thing is that inventory is now $4.5 billion. This is continuing to creep up, almost double recently, and it's going to be a big concern that if they can't shift the inventory, they may have to sell at reduced prices, which is not good for gross margin. This table just shows the quarterly revenue trend, the change quarter over quarter for the last few years, and you can see data center and auto have had a steady increase over that time, auto nearly doubling and data center just about doubling from in the last 2 years or so. impressive growth going forward, and I think these are going to be two meaningful segments going forward. Particularly auto is going to raise in meaningfulness for this company going forward, in my opinion. Gaming, on the other hand, clearly peaked a couple of quarters ago at $3.6 billion. That's more than half since then, and it looks like this is going to be a struggle going forward because the graphics cards, particularly with cryptocurrency mining, just don't have the same utility they used to have, and there's a lot floating around on the aftermarket right now. This is going to be a big concern for Nvidia moving forward. While I don't think this impacts the long-term health of this business by any means, I think lower demand in the short term is going to make some of the revenue particularly lumpy. Next thing about Nvidia, the stock, and there's no question right now by basic valuation metrics, now that the revenue growth has really dried up, this is looking like quite an expensive stock. P/E ratio on a forward basis of 35, on a trailing basis 52. For the sort of revenue growth this company is putting in, which is essentially nothing right now, is very, very expensive, even with its excellent gross margins. Price free cash flow of 64, 65, very, very expensive. Even with a PEG ratio of around 1.5, which I'm skeptical on right now, this is a very tough company to look at objectively and say this is undervalued right now. Now, of course, if it returns to its previous growth of, well, it's got an average growth for around 30% revenue the last 3 years, then this will, of course, be an excellent business. But that is easier said than done. A lot of these companies are coming under pressure, and Nvidia, while it is the market leader for GPUs, does have formidable competition from AMD with lower price products. This potential overvaluation is supported by a DCF calculation that I've done recently. Again, as free cash flow growth has all but dried up, on a trailing 12-month basis, it's around $2.47. January 2022 for the full year is $3.21. It's going absolutely the wrong direction, and it's not really looking like it's going to buck the trend going forward. Even forgetting about that and taking this number as what it is going to be, adding a 20% growth rate, 9% discount rate for long-term returns to the stock market, this is looking like an expensive stock. Today's stock price of $159 and a fair value of $93.84. Now, of course, 20% free cash flow growth rate is very, very high. They have averaged 30% over the last 10 years. I don't think they can do that going forward. The revenue growth rate over the last 10 years is around 20%. I definitely think they could keep 10 to 20%, if not higher, going forward, but they won't be doing that in the start of these 10 years. So averaged across, I think an average growth rate for the next 10 years could possibly be around 15%. Free cash flow grows in line with this. This is looking like a very expensive stock right now. I think the problems this company is having are not short-term in nature, and it's not looking like a buy right now, in my opinion. That is really the summary for me. I think this is a fabulous business that is undoubtedly going to be bigger in 15 or 20 years. There's huge demand for its products and long-term tailwinds. However, right now, I can see that P ratio and the price-free cash flow ratio being extremely inflated and pushing up because the earnings are just drying up. The gross margin is coming under pressure. They're going to produce less earnings, less free cash flow, and the valuation is going to skyrocket in the near term. I don't think it really has the revenue growth and business quality to support this type of valuation right now, nor do I expect its valuation to get any lower in the near future. I can fully see this stock price plummeting in the next 3 to 6 months as its earnings come down and its P comes under pressure. That being said, I'd love to be proven wrong, and again, I think over the long term this could be a fantastic investment. I just think it's going to be at a cheaper price in the near future, and if it isn't, so what? I'd be happy to pay in the future once it comes back to 20 or 30% revenue growth. If that happens, I'd be quite happy to pay the current prices right now, but I'm more than happy to wait on the sidelines, and personally I prefer to invest in AMD right in the minute. Of course, you should let me know what you think in the comments below. Let me challenge my views if you want. Let me know if you think I'm right or wrong. I don't think this quarter is a disaster by any means, but I definitely think there's a bumpy road ahead for this business and it's going in the wrong direction. Let me know what you think. Like and subscribe if you enjoyed the video. I'll see you again next time.